Okay, what is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be doing some stock analysis on Vishay Precision. This stock is up over 300% in the last year. The market cap now is only 1.4 billion, so it's not that big of a company. It was founded in 2009, and the price to earnings is now over 200. So investors are very bullish on this stock. If you don't know what they do, they engage in the provision of precision measurement and sensing technologies, serving a diverse array of industries, including industrial, transportation, steel, medical, agricultural, military, space, all this stuff. So recently they reported earnings, and that's been a huge catalyst for the stock. It says up here the company said growth was fueled by solid demand across semiconductor equipment, data centers, avionics, military, and space applications, along with selected industrial markets. And bookings reached over 100 million during the quarter, increasing 25% sequentially. Now, if you look at their actual numbers, it's nothing that impressive. Their revenue peaked a couple years ago, and then the last couple of years here, they've been growing at like 7, 8% per year. This year they're supposed to do 13% revenue growth. Next year they're going to do 6%. So the sales side is not that interesting. But what is really shocking is the fact that they're doubling EPS supposedly this year, and then next year they're supposed to double EPS again, which is insane, not only for any company to do, but for a company that's only growing around 10% per year, that's a lot. So my thing though is, so let's say they get to $1.6 EPS next year. Okay, that would be roughly four times what they're doing for earnings right now. So what did they just do for earnings? They only did $6 million net income. So keep that in mind. That means it's only $24 million of profit in that would be for next year. You see, so their net income has long ways to go. That's the thing. They a couple years ago they peaked at 36 million, and look how much of a hit this has taken. Now let's look at their margins real quick. Profit margins these last couple years must have gotten destroyed. Yeah, because right here it was at 11, 12%, which is still just like mediocre, and now it's negative. Return on capital, same thing, peaked a couple years ago at 11, 12%. Now we're down to only 3. So the numbers are kind of weird on this company. Um, so, again, though, my thing with the EPS though is in 2028, 2029, unless they can keep growing this at these huge clips like this, where maybe they do $2 or $3 EPS in a couple of years, this stock is pretty overvalued right now at $105. I will say though, like we're gonna get into it in a second here, but their potential with the robots and stuff, and the semiconductor chips and data centers, that I could see having a good amount of growth, especially the robots. That could be like literally like you could grow off of the robot market hasn't even started really yet. I mean it's we're like getting introduced to it, but as far as like an actual sellable robot that's on the market, it's very limited right now. And once that gets started in the next couple of years, I mean, who knows for how many decades is that going to grow? That's something that we're going to see grow for decades and decades. Other than that, their cash to debt balance, 80 million to 20 million is solid. Shares outstanding is good. And that's kind of surprising for a company like this that has low net income, not great margins and stuff. I'm kind of surprised. But if we break down into this chart right here that Claude has so kindly provided for me, we could see first, what is the company's moat? Well, once qualified into aerospace, defense, semiconductor supply chains, customers almost never switch suppliers. This is something I hear about with almost every company that I analyze, and some of them are exaggerated, some of them I do believe. This one, I don't know enough about the details about their supply chains and stuff to really decide is that a strong moat or not. But it says recertification is extremely expensive and time consuming, often 2 to 3 years. Okay, and sure, that's something to consider, but companies switch suppliers and partnerships and all that like all the time. So just because there might be some little switching costs, even if it costs them extra money or takes a little bit longer, companies will do that if they think it's the right strategy. So just keep that in mind when you hear stuff like that. VPG has decades of certifications with Lockheed, Boeing, TSMC adjacent equipment makers. I don't know if that means, I mean, is that like Intel? Is that Intel, Samsung? Could be ASML? Not sure. This is the strongest moat layer. Then, secondly, we have precision measurement at the microstrain level requires proprietary foil technology, decades of calibration know-how, and a team of physicists and engineers. You can't replicate this in a few years. Okay, maybe, maybe not. Again, with the world that we're in nowadays, I mean, literally over the last 20 years, the way the world and technology has evolved, where things happen so much quicker. Every couple years now, technology develops faster and faster, companies scale faster and faster, everything moves quicker. So it's not like it's 1993 anymore, and it- companies stay in, keep their moat longer and stuff. Like, we're in a different environment now. VPG's foil strain gauge technology and load cell designs are differentiated at the physics level, not just at the manufacturing level. But again, who's to say a newer company can't come on the scene, make the right partnerships, hire the right people, get the right funding? Anything can happen. Precision instruments require regular recalibration to maintain accuracy. This creates a recurring high margin aftermarket revenue stream. Customers who buy a measurement systems installation are effectively locked in for service contracts 4 years. Okay, and that's the same thing. That's probably likely to happen, not guaranteed. No single market dominates. Aerospace, defense, semiconductor data centers, industrial automation, medical and food processing all contribute. Now that's good. They have the diversification they have with their revenue streams in terms of markets and industries is phenomenal. This means no single downturn kills the business, and that's very true and very important. And multiple secular tailwinds can layer on simultaneously. Now, VPG is now in engineering discussions with four humanoid robot developers. At $400 to $500 of sensing content per robot at low volumes, a ramp to millions of humanoid robots is transformative, which we're likely to see probably in the next 10 years. First mover qualification advantage here mirrors what happened in aerospace decades ago. That part is interesting because if you think about a couple $100, let's say it's $400 per robot, millions of robots means hundreds of millions of dollars. And so if that adds $500 million to their revenue the next couple of years, again, it could take 5 years or 7 years, but that's going to more than double their current revenue. So that's good. Which here it states that's the highest upside. Their management is assuming 50% annual growth. That's reasonable. I mean, it's reasonable, but at the same time, I can also see it almost being something where like they might double or triple their earnings in a year or 2 years or something when they get if they get a bunch of business from this. If robots explode in a year or two from now, then they might get a bunch of business and they're like Nvidia experienced the last couple of years where their earnings triple or something in a year. But is that going to happen for the next 10 years? No, probably not. It'll probably drop back down to whatever, 30% growth or something. But whatever. Let's just assume they're saying 50% annual growth. To me, this could seem like, to me, it seems reasonable, but I could also see it greatly jumping from that range. Like, where if you have a really good year and let's say you get a really strong partnership, you sign a really good contract. Well, $4 million is not a lot compared to what it could be. So they might go from 4 million to whatever 15 million. Like that could happen. Otherwise, in 2 years from now, will they be doing 14 million from this? Maybe. And I mean, I don't see why not. At scale, this becomes a $500 million plus opportunity, and that's great. I can see that. Active now. The precision resistors and chip fabrication equipment, okay, ASML, like I said, and data center fiber optics are surging right now. This is driving current bookings growth and is the most near-term dependable catalyst. Great. NATO rearmament. I've never seen that word. Rearmament. U.S. defense budget expansion and next-gen avionics programs all require high precision sensing. Long procurement cycles mean visibility is unusually high. Bookings made today convert to revenue 6 to 18 months out. Good. And that's why I do like that they have all these different revenue streams in different industries. That's nice. Margin recovery and cost program. $6 million in cost reductions targeted for this year with $20 million total over the 3-year plan. VPG's target model calls for 46% gross margins, blah, 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 blah. VPG set a $45 million target for new business development revenue this year. Now, this is the interesting part. Let's look at the bear case. Okay, bear case, let's just pay attention to 2030. 2030, they scale net margin up to 7%, gross margin improves, net income's at 27 million, $1.60 at EPS. Keep in mind, they're supposed to, let's see, I wonder if this is gap. EP, let's see. Yeah, no, wait, no. Let's see. No, it's not. Because 2026, 50 cents. What are they supposed to do here? Um, I don't know. Those numbers are slightly off. But anyways, the point is, let's see. Dollar 81. Okay, so it's close. So basically, what they're saying, what Yahoo has them doing next year for EPS is basically what the bear case would be for 2030, in other words. And that would, the bear case means 18 to 25 times earnings. And you're looking at a $30 stock. Now let's look at the base case. Base case margin is at 46%. Net margin is at 12%. Net income 67 million, adjusted EPS $3.80, which is way higher. And then 25 to 35 times a PE, you get the stock at about $100 or so, which is where we're at right now. That's what I see happening. I see this being worth $100 4 years from now. And of course, with so many stocks out there, investors like to pay for the next 5 or 6 years of earnings growth. And next thing you know, the stock that should be $100 in 2030, it's actually $100 now. So if they make all this stuff happen, if they do $3.80 of EPS in 2030, it's already priced in, so the stock's it's not gonna go anywhere. And then we have the bull case, which seems that's like what investors are pricing in right now. This would be the only way you make money is in 4 years the stock's trading at 50 times earnings, a $300 stock price, and the EPS is over $6. Which keep in mind they just did 40 cents. They're supposed to do 80 cents. This just doesn't seem realistic. Net income of $120 million in 4 years after their net income right now is $6 million. So do you think in 4 years they're going to go from 6 million in profit to 120 million? I don't know. That would mean that, yeah, exactly. Robots ramped faster than expected. AI infrastructure sustains. That's another one where I'm interested to see what happens with that. Like, is the data center spend and all that gonna, how consistent is that gonna be, or is that gonna just fall off a cliff after, the next year or two? Margin targets are hit, and humanoid robots revenue reaches over 50 million. Like I said, things move fast nowadays, so who knows? Look how fast AI has moved in the last 4 years, right? Look how fast companies can scale now to building huge businesses, providing extreme value. I mean, stuff happens fast. So who's to say that robots don't explode in a year or two from now, and next thing you know, it's whatever, $100 million, $1 billion, could be. I mean, really, it's probably going to be a multi-billion-dollar industry. It's just how much of this is actual a total addressable market for this company. I don't know. It looks like it would be about whatever. It says 50 million 4 years and then eventually a $500 million. I think long term, like 10 years from now, it could add $500 million to them. So in other words, however much it costs to build those, like a humanoid robot, like it looks like it's going to cost like 10 grand or something, or probably maybe 7 grand. No, yeah, somewhere in that range. Let's say it costs 10 grand to build a robot. Well, if they're making only $500 off the robot, that's not that much, right? How much is that? That's like 5%, right? So keep that in mind. Revenue forecast, the core business, the humanoid robot section is only 38 million, and then AI infrastructure 76, and defense aerospace. So, what do we have here? Robotics timing. Risk is high. Valuation, for me, I think it's very high. Thin analyst coverage, okay, that's not super important. Semiconductor capex cycle turning, yes. And then the low risk ones are core business customer concentration and balance sheet liquidity. So, like we said earlier, 4 years from now, the base case is the stock's gonna stay at where it is now. But I think the stock's gonna come down. I think we're gonna see the stock come back down to $40, and then yeah, I mean, could it be a time to buy then? Potentially. I'd like to revisit it and see what happens over the next 6 months that causes the stock to go down. And I mean, I don't think their sales growth can get any worse. But again, it's when you have a small company like this where you literally have a small company that is diversified, already has customers in business, and is on the verge of not only acquiring huge amounts of profit from huge amounts of business from the AI, the CapEx spend, but also on the verge of capturing this humanoid robot market over the next 10 years or whatever. That's a very hard thing to value because if things don't work out and a competitor eats all their lunch, then this company is not worth a lot, right? It's going to trade at a price to sales of like a two. But if they get the right contracts, and next thing you know, this company is doing whatever, $1 billion of sales in a couple years, well, then I could see why the stock trades at this price. So that's kind of the way I'm looking at it right now. I mean, the moat, let's see, they say the moat is real. The core strength is a long-term history supporting mission-critical applications where accurate, reliable, and highly precise sensoring is non-negotiable. And that's a very good sign. That probably puts them ahead of a lot of companies. So the switching costs in aerospace and defense is as strong as the moat gets. Once you're in those supply chains, you stay. Okay. And maybe this is just Claude being overly confident, but it sounds, I've never ran an aerospace and defense company, but if the moat is actually that strong in the supply chain, then who knows? Maybe this company really does have the best chance at being the dominant player. The robotics angle is the most interesting part. At production levels of tens of robots per week, sensing content per robot will be $400 to $500. It's meaningful at scale, but right now they shipped out only about 600,000 a product. Okay. 3-year plan calls for 10% annual organic growth. See, they're not a high growth company. But again, if they get the right contracts, then the growth should explode. And I'm even surprised at how they're doing this huge jump. Well, no, really, if you think about it, their margins have come down so much that they're probably just going back to baseline because you shouldn't be making 6 million in profit when your company does over, I mean, if you're doing 300 million in revenue, $6 million in profit is pretty low. So, um, yeah, like I said, if this stock when this stock comes back down to 40, which I think it will, it'll be interesting to look at then and see. Pretty much, I need to see them get a good contract or something. I mean, it's great that they say that they have this huge moat and stuff, but I don't know. I mean, you'd have to have some high conviction in this that they are going to be the dominant player. You don't have to worry about competition and all that. So that is my analysis for this. Let me know what you guys think down below, and I will see you in the next video.